Okay, welcome back to Self-Managed 360. In the previous video, we've talked about assessing the profitability of a company by using its financial statements, mostly the income and cash flow statements. We will now discuss the balance sheets, which are also provided in the financial statements. The balance sheet is the third key component of a financial statement. It can be found again in the annual report. So before we go into reviewing how to review or to evaluate the balance sheet of a company, the balance sheet should be seen as the medical bill of the company in terms of its financial health at any given time. So the balance sheet will provide the list of the assets, the value of the assets owned by the company, and the list of the liabilities owed by the company. So it's going to be, you have to see it as a snapshot of the financial health. So it doesn't mean that if a company has a solid financial health or a solid balance sheet in 2010, that it's going to remain the same for the next 20 years. It need to be reviewed every year to make sure that the company is controlling its balance sheet decently. So we look at the screen here. The balance sheet is often a list of items that are considered as assets and liabilities. The name balance sheets come from the fact that if you add up the value of the current asset, which we'll discuss later, plus the non-current asset, it should add up to the same value as the total liabilities, which is the current liabilities plus the non-current liabilities, plus shareholders' equity. Shareholders' equity is a key value that we will use in our assessment of a company. It's basically the value of the assets that are debt-free. So if you have liabilities plus shareholders' equity, that's going to give you the total value of the assets owned by the company. So as I've done with the income and cash flow statements, we're using a fictional company named 123 Hardware. And 123 Hardware has been in operation from 2007 to 2016. So we went into every single annual report. We've taken the values provided in the balance sheets, and I've put them on the same table so we can compare how the balance sheet is progressing as we move in time. So first thing we want to look at is, it's called the current ratio. So if a company has current liabilities, it means that the value written here will have to be paid for in the next 12 months. This is where a current liability is owed in the next 12 months, and non-current liabilities or long-term liabilities need to be paid for in the next after 12 months, so in the future, but not in the next year, calendar year. Same would be said of the current assets. Current assets are assets that can be converted into cash within a year, and non-current assets are assets that may not be easily convertible in cash in the next 12 months. So it can be converted in cash after 12 months. Obviously, it's just accounting principles. Some non-current assets could be converted in cash quicker, but stuff like properties and industrial equipments are considered non-current assets because they may not be able to be sold for their value in the next 12 months. Cash, account receivable, inventory, prepaid expense, stuff like maybe if a company also owns shares of other companies, you can sell it back to convert it back to cash. This would be considered as current assets. So the current ratio is basically you would divide the current asset by the current liability. What that gives you is if the ratio of the current assets divided by the current liability is above 1. That, in our case, that would be the case. If I divide this number here by 70, I will have a number way more than 1. That means that the company has plenty of current assets, cash equivalent, to pay for its short-term debt, which is good. That means that in the short term, the company is not in any financial problem to pay back for its liability and to keep operating. Obviously, my example here may be a bit overstretched because often companies will not have that much current assets versus current liabilities, but you may want to invest in a company that has a current ratio of 1.5, 50% more current assets than current liabilities. Is that good enough? Well, try to stay above 1. Do not invest in companies, or try to avoid investing in companies that have a current asset of less than 1, because there may be a doubt here on their capacity of paying back for their short-term liabilities. So we want to try to stay away from these types of companies, and we want to invest in companies that have a current asset of more than 1. Ideally, more the better, but 1.2, 1.5 could be good enough. But try to avoid companies that would have less current assets than current liabilities. Then, second thing we want to look at is the shareholders' equity increasing or not in time? Why would we want to look at that? Well, shareholders' equity is the value of the assets that are debt-free. That means that if every year the value of the assets that are debt-free is increasing, that means that basically these assets, or the value of these assets, belong solely to the company, so it belongs to the shareholders. So if the shareholders' equity is increasing, you have to look at it as the company is creating value to the shareholders, and we want to invest in companies that are creating values to us if we become shareholders. So we want to look at trends. So in our case, last 5 years, shareholders' equity have increased big time, and it went from a negative shareholders' equity, so more debt than total asset. So basically, if you want to balance, you need to have a negative shareholders' equity, to a very positive shareholders' equity. So we can say that 123 Hardware in the last 10 years has created value to the shareholders, which is good for us. We can also look at how the liabilities are increasing. So basically, we went from a liability of our total debt of $832,000 to $775,000. So we can say that the company is controlling its debt, is keeping its debt level at a manageable value. So try to not stay away from company. If the company is increasing its liability, but it's to finance new assets that will, at the end, will they create value. So basically, if you raise debt in order to raise assets that will generate shareholders' equity, it should not be seen as a bad thing. But if you see liability go up, if you see shareholders' equity stable or decreasing or slightly increasing, and you see assets not increasing as much as liabilities, then you may see a potential problem here, that the company is not in total control of its balance sheet. So balance sheet, we will look for the current ratio. So we will make sure that the current assets exceeds the current liabilities by a ratio of at least 1. Obviously, if it's 1, it means that we have as much current assets as current liabilities. So we want to invest in companies that have a ratio above 1, ideally above 1.5. Again, this example may not be relevant. Well, there are some companies that can provide you such a current ratio, but probably they would start to pay some dividends to the shareholders. And we want to make sure that the liability is increasing at a slower rate than the total asset, and also than the shareholders' equity. That will give us a confidence that the balance sheet of the company is under control and that it's creating value to the shareholders. So if we are a shareholder, we want to see a company creating value for us. So we will look at these key values from the balance sheet to make sure that we invest in a company that will, at the end of the day, create value